Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research. Today we're going to talk with Joseph Boskovich. Joe is the founder and chief investment officer of Old West Investment Management. He is a value guy just like me, so I know we're going to have a great talk that you'll enjoy very much. Let's do it. Let's talk with Joe Boskovich. Let's do it right now. Joe Boskovich, welcome to the show, sir. Thank you for being here.
Thanks for having me.
So, Joe, you're a new guest. We haven't had you on the show before. So maybe we'll dive in and you can just tell the listener who you are and what you do, and then we'll talk.
Sure. Okay. Yep. My name is Joe Boskovich. I am a third generation Californian. I founded Old West Investment Management in 2008, right in the middle of the Great Recession. We opened our doors November the 1st of 08.
Wow.
When the entire economy seemed to be imploding.
Great time to buy stocks.
Well, I think the worst of times I think is the best of times to start something, right? And it turned out to be the case. But my background is actually in agriculture. My family has farmed in California for over 100 years, and between undergraduate and graduate business school, I took what was going to be a temporary job with my family. The temporary job lasted 22 years. Built a big family company. It's still in business today. It's Boskovich Farms, California headquartered grower, shipper, processor of fresh vegetables.
That's a heck of a good part-time job you got there, Joe.
I know, right. Yeah. And then as I approached my late 40s, I was approaching 50 years old, and I thought, was I ever going to do what I always dreamt of doing? And that would be, I just had a lifelong affinity for picking stocks and analyzing companies. And so I did a complete career change and to what I'm doing today. And it's right. I'm blessed because I've had two different careers that have both been very fulfilling. Pretty hard to beat working side by side with your dad and your brother for 22 years. So that was great. And then I've, really but I think a key point would be that the fact that I ran a company, most people that do what I do, they've been buying and selling stocks their entire career. And so the fact that I actually ran a company for 22 years, I think makes me a different kind of an investor.
Yep.
I really look at it like buying a company, not buying a stock. And I take a different angle towards the company I'm analyzing. I put huge weight on management and the people that run these companies. So it's really a key to our investment process. But that's a long-winded answer to who I am and what I'm doing.
Exactly the kind of answer we like around here, Joe. Thorough, right? We're not in for sound bites. We want the real story. So, focus on management is what really, out of all that, boy, that's the thing that caught my ear. Plus, you reminded me of what Warren Buffett has said many times. I'm a better businessman because I'm an investor. I'm a better investor because I'm a businessman. The two work together, and I've seen it in others too.
Sure.
I'm not much of an entrepreneur myself, but I'm a decent investor.
Well,
And
if you
so
think about it, companies are really just a collection of people, and I think that the people that run the companies it's just beyond huge. The importance of the people that run these companies, and especially the CEO. And so yeah, no, I and there's a lot more to it, but it's definitely a key part of our process.
Right. This is fascinating in light of another famous investor. I'm pulling famous investors out of my hat, left and right here. Peter Lynch, who often said something like, "You want a business that's so good anybody can run it." It doesn't quite work out that way in real life, though, does it? You know, you can have a
Well,
great
I think if
like
you
you see
take,
founders coming back, you know, like Howard Schultz had
yeah,
to go back to Starbucks and all that stuff. The person mattered. The people matter.
no, they do. But I think I mean, he's right in terms of, say, a Coca-Cola, a Procter and Gamble, a Johnson and Johnson, where
Right.
in these real big classic old companies, the CEO in many cases is almost a placeholder. But
Almost.
when we're value investors, we're deep value investors, and so it's a different kind of a game than buying one of these, a Coca-Cola. What we do is much different, and where a and in many cases it could be a turnaround where there's much more value placed on management.
Right. Yeah, to get deep value, you're farther down the quality trail than, you know, Berkshire Hathaway or Coca-Cola or something or American Express or whatever, right? So
Well,
you
I would not. I don't agree with that. You say
no?
deep
Okay.
down, deep down the value trail, but what
Not,
it
yeah.
could be an outstanding company that
Mhm,
is just misunderstood by the market
mhm.
and is cheap. But
Yeah.
don't confuse the stock price with the quality of the company.
Well taken. Point well taken. I was thinking of specific. I was generalizing about some specific instances. So, but absolutely, point well taken. Don't think the stock price or the market valuation, to be really specific, is indicative of the quality. Right? It's just
Maybe the market has it dead wrong.
right, which
Mhm.
does happen despite
Oh, yeah,
much
it does.
academic bluster to the contrary.
Right.
Right. So that's interesting. Deep value. So can you give us an example?
Yeah, I mean, many examples, but I can give you
Right.
an
The
example.
more the better.
I can give you an example of a company where a new CEO made a huge difference, and the company is Bunge.
Hmm.
This the symbol is BG, and it's a worldwide agricultural distribution company,
Right up
and
your alley.
the ag world, which I mean, think how big it is. It's not that food is important, other than the fact that we do it all day long, all of us. So yeah, big business. It's
Hmm.
dominated by four companies worldwide.
Hmm.
Uh, Two are private, two are public. The privates are Dreyfus and Cargill. The publics are Archer, Daniel Midland, and which is probably better known, and then Bunge. But Greg Heckman came in as the new. Bunge had been mismanaged for years, and stupid investments and misallocation of capital. And so Greg Heckman was a longtime ConAgra executive that they brought in to right the ship. It's interesting when you talk about, does management matter? One of the first things he did is he asked the question, we're an ag company. Why are we in New York? And so the first thing he did is move the company from New York to St. Louis, right in
That's
the middle
great.
of the. Don't you love that? Right in the middle of the breadbasket. And
Yeah.
and do CEOs make a difference? And along, it reminds me of another one is Boeing, where the Boeing past CEOs lived in Connecticut and they lived in New York and they lived everywhere else. And Boeing, I mean, obviously Boeing, really controversial, really had a tough time. They hired Kelly Ortberg as the new CEO, and the very first thing he did is he moved to Seattle. And if you recall the nature of Boeing's problems, What caused their problems were some quality issues, the door blowing out, the plane crashing. I mean, you know, so where do they make most of the planes? Seattle. Why has a Boeing CEO never lived in Seattle? Simple
Makes no
question.
sense. Yeah.
Kelly Ortberg was retired in Palm Beach, Florida, living the good life, playing golf, takes this job. First thing he does is move to Seattle. And of
That's a
course,
statement. In light of that history, that's a real statement, isn't it?
well, and if you look what's happened to Boeing since he took over, and he's a wonderful, wonderful CEO, and so you know they have, I mean, and the stock is up by, I don't know, maybe 30-40% since he took over, but it's really a great turnaround story. But what a simple thing to move to Seattle, right?
Yeah.
And so, but back to Bungie, and so Greg Heckman says, "Why are we in New York? We're moving to St. Louis." Which, by the way, you know, takes himself out of it. I mean, most people would rather live in New York than St. Louis, but what's best for the company? So just one small example, and how I got onto the idea. It's actually kind of a funny story. I follow insider activity very, very closely.
Hmm.
I mean, even though you know we have a team, but one of my little exercises every morning is I go through every Form 4 filing published by the SEC every day, and for all 4,000 companies.
Every
And
Form 4
so,
every day. That's amazing, Joe.
yeah, it takes about an hour of my
Mhm.
morning, and but it's probably my favorite filter of looking for new ideas and of what to own and also what not to own. And so, but what I saw. I'd seen Bungie here and there, but um, pretty funny. I didn't know how to pronounce this. Bunge. So is it
Yeah,
Bun? Is
me
it
too. Yeah.
Bunge or Bungie or Bungie? So anyway, but I see a $10 million open market purchase by Greg Heckman. Then I look at that. I go, oh my God, he's the brand new CEO. $10 million purchase, and I said, well, it has to be a stock grant. I'm sure they gave him $10 million worth of stock as a signing bonus to come in. But I thought maybe not. What if he did? What if he did write it? What if he did stroke a check for 10 million bucks? And so I called investor relations. No one called me back.
Hmm.
Then I called a second time, and nobody called me back.
Hmm.
But something was really gnawing at me, and so I called a third time, and one last time. And finally, the assistant, not the head of IR, who should have called me, but the assistant IR person called me, a young man, and we start talking. And I said, my first question is, how do you pronounce the company? And he goes, Bungie. Okay, all right, so get that out of the way. It's Bungie. And
Okay.
that's my first question. My second question is Heckman. I see a Form 405. So just in case the viewers don't know, when an insider of a company buys or sells even a single share of stock, they have to file a Form 4 with the SEC within 48 hours of the transaction. And so, this is, you know, so I'm looking at these every now. You said there's hundreds and hundreds of filings every day. How do I have time for that? I basically only look at transactions in excess of $1 million. So that narrows it down to maybe just a couple of hundred transactions a day. And but the larger numbers pop out. And so and so 10 million. Oh, so I call IR. They finally called me back, you know, the third time. And I said, let me ask you a question. I said, was that really his, did he actually write a check for $10 million or was that a grant? And they, well, it was both. He had a grant for 10 million and he bought $10 million worth of stock. And I go, wow, that's really impressive.
That
I,
is.
I rarely see that a new CEO would write a check for $10 million. That's pretty strong conviction. And then I start looking deeper into it, and I see the move from New York to St. Louis. So I'm getting the idea that this just might be a real no nonsense individual that really is going to make a turnaround here. And but if you look at the, it's, I want to say it's trading at 10 times earnings with a 3.5% dividend yield. And but when I said it's been mismanaged for years, um, um, and it has been. And so he cutting expenses, just cut, selling non-profitable operations, cutting overhead, buying some new opportunities, and just so it's kind of almost like the conductor of an orchestra, a great CEO doing these things, and. And of course, I think one of the most important jobs of a CEO is how to allocate capital. And now I'm going to give Will Thorndike some credit for this. Will Thorndike wrote a book called The Outsiders and the greatest corporate CEOs of the last century. And but he says, and I believe this is the CEO has five choices on how to allocate capital, and I haven't come up with number six. You can reinvest in the company and grow it organically. You can buy other companies and grow through acquisition.
Mm-hmm.
You can pay down debt. You can pay a dividend, or you can buy back your own stock,
Right.
or some combination of those. But companies are notoriously bad for buying back their own stock. Companies are buying back their own stock hand over fist today.
Yep.
They were buying back their own stock hand over fist in 1998 and 1999, and in 2004 and 2005 and 2006.
No regard for fundamental value whatsoever.
Stock,
Correct.
Stock repurchases by companies completely dried up in 2001 and 2002 and 2003. Completely dried up in 2008 and 2009. And isn't it ironic? Wouldn't you think that a corporate CEO that's engineering stock buyback plans would want to buy back their stock when it was hugely selling off and cheap and the market was horrible?
You'd
And
think.
wouldn't you think they'd have their hands in their pocket right now? And it's just the opposite, unless you're a huge shareholder of the company yourself, and you're running the company. And so when a new idea comes before me, the first thing I do is look at the proxy. And the proxy is going to show me the level of ownership of management, and it's going to show me compensation and how they compensate themselves. And so I love seeing companies where there's very, very high ownership and very modest compensation, because when the CEO is a big owner of the company and doesn't pay himself very much, Warren Buffett pays himself $100,000 a year, and that's all he's ever paid himself. And so basically, when you invest in that company, your interests are aligned with the people running the company, versus most companies where there's just a giant compensation package, and that CEO is going to knock down $25-30 million a year no matter what, and I really don't have much interest in that. So
Right, and the stock repurchase plan becomes part of the compensation because they're compensated with stock. They try to support the shares or whatever, and so it's the
well,
incentive get a little twisted.
and that's a whole other issue. Is GAAP accounting versus adjusted earnings, and of course today all companies report adjusted earnings.
Yeah.
Nobody gives a damn about GAAP earnings anymore, and which is really a crime, because one of the biggest differences between GAAP earnings and adjusted earnings are backing out stock-based compensation. And your viewers may not know that, but that's the single biggest. And I would just challenge you when you're looking at a company, compare that GAAP earnings versus adjusted earnings, and all these technology companies. Meta paying these $100 million bonuses for these new AI superstars. It's all adjusted out of earnings. It's all backed out, and so I think it's very, very important to look at GAAP earnings.
Yep. And the again, the share repurchase turns it into a backdoor cash bonus, right?
Correct.
It's just a different way of getting them the cash.
Correct.
Yeah. So Bungie, that sounds like a neat one. Actually, right now, headline, PE ratio just on what is it, Yahoo Finance is like 8. I mean, and a
Right.
3.5% dividend yield.
With a giant dividend yield. Now, would you rather
Yeah.
buy that or Nvidia today? I mean, I would rather. I'm a value guy. I would rather own
Yep.
Bungie.
Absolutely. I've been writing a newsletter called Extreme Values since 2002. So,
Great.
yeah.
So
we're on the same page.
Bungie would qualify.
Yeah. You just put it on our radar screen. I'm going to shoot it to my partner in crime and see what he thinks.
Great.
Yeah.
And once again, management is huge, and Greg Heckman is doing a wonderful job of turning the company around.
Okay. So Bungie's current idea.
Oh yeah.
Yeah, and you mentioned Boeing as well. Is that current or past or?
We have a small position in it. The airline business is so scary to me. And I mean, I know it's there. It's an essential part of life. I just boy, so many things can go wrong. But we do have a small position in Boeing.
So bringing Boeing up actually doesn't make me want to talk about Boeing for reasons of internal conversations and things that I've had over the past year or so. It makes me want to ask you if you have an opinion about Disney because of what has happened with that company, with the output of their products has become a strange, different thing than what it used to be.
Right. Yeah. We don't own it, and I've never owned it. I think that whole content business is so difficult and so fast changing with streaming and the competition. Been watching this Paramount Skydance thing, which is a bit intriguing to me because I think that this David Ellison is like his dad is brilliant. But I think it's just it's a tough business. It's a tough place to play. It really is. And of course Disney. I mean, the theme parks and everything else. And it's a great franchise. It's a wonderful American company. But really, I don't. It's not an area that we like to play in, like the whole content business.
I see. Okay. Our conversations that I've referred to internally have focused on is the brand permanently damaged by the woke, what you might call the wokeness of the content. Have they really forgotten how to make movies? One person is the way one guy put it. But
Yeah,
the
no,
content.
I get that. I get
Mhm.
that. At the same time, I'm watching my 2-year-old granddaughter watching Mickey and Minnie, and she's just completely delightful. It's kind of funny. Her first, she used to love this show, Miss Rachel. Have you ever seen Miss Rachel?
I have. I know Miss Rachel well. I have two grandsons who watch it. Yeah.
And so, it's funny. I used to turn my nose up at parents in restaurants that have the kids on iPads,
Mhm.
but then I have this little 2-year-old granddaughter that's very rambunctious and hard to keep in her seat. And until you pull out Miss Rachel, and then she's glued to her seat.
Yep.
But now she's now graduated from Miss Rachel to Mickey and Minnie. And so I'm
Oh,
sitting there saying, isn't that, it's just such a wonderful, wonderful franchise. My God.
yeah.
But yeah, it's all good. But yeah, no, I think that, yeah. And I think they have management, I mean, Iger had to come back and,
Right.
and so that was all kind of botched and they still have no heir apparent. They have no replacement. He is no spring chicken, been at it for a long time. So anyway, there's a lot to like about Disney, but I have no stake in it.
Which speaks for itself, does it not? Yes.
Sure. Right.
um, okay. So when you said deep value, as we sort of realized, my mind went to a certain place, and it went to, when I think deep, I automatically think distressed. But Bunge isn't what you would call distressed, right? It's a good business that suffered from bad management for a number of years.
Absolutely. And it's also in an industry that's kind of known for like low margins and
Right. Commodity
and
industry.
and,
Yeah.
and intense competition, but
Hmm.
it doesn't need to be that way. You just need the right person to figure out, get rid of the bad assets. Let's get involved in good things. And I mean, you have, a world of 7 or 8 billion people that need to eat. For God's sakes, there has to be a way to make money in that. And
Yes.
so yeah. So I kind of it's out of favor, which makes me like it. I think deep value. You can have deep value. You can have extreme quality. So and then you mentioned you just briefly said commodities a second ago,
Hmm.
and so in terms of deep value, and we have really found amazing value in the commodity area. And maybe it's my ag background. A lot of money managers shy from anything to do with commodities. Uh,
Yes.
and I understand why, because it's hard enough to get the company right, let alone to get the price of the commodity right. So it's doubly tough.
Hmm.
And on the other hand, boy, if you look at the commodity uh, uh, sector of the S&P,
Hmm.
has never been lower,
Right.
and never been lower than today, which excites me because I believe
Ditto.
in ultimate reversion to the mean,
Yep.
and I think the market eventually comes down. Commodities eventually become a bigger part of the market, like they have been historically. But where we have found just extreme value is in the metals and mining area, and we have right now, which is kind of crazy, but we have half of our portfolio is in metals and mining companies,
Wow.
which is just like um, where I think the S&P is like 2% metals and mining, and we're 50% metals and mining.
There you
So
go.
right, but I think I've learned one thing: the way you make you really can't make money in this business by thinking and being like everybody else. You don't want to be different just to be different. But I think where you make money is by having, your own
Right.
thoughts and ideas, and basically, you know, not going. The penguins all go over the cliff together, right?
Yeah.
And they again and again. It's been a while. The Penguins haven't gone over the cliff for about 15 years,
Yeah.
but they will eventually. They always do.
They
And
always do.
yeah, but we know we have found extreme value in the metals and mining sector. My partner Brian Lax has really driven our move in this area. Um, when I first met Brian, uh, we first met about 10 years ago before he came to work for us, and the person who introduced us said you guys need to meet each other because you both like gold. And I said, I'd like to meet this guy. And that's how we first met. And, we liked gold 10 years ago. We've finally been proven correct. It's taken a while. But I think that, and then we'll go back to that. But, how do you own gold? Well, today it's all about ETFs. Today it's all about index funds. And so nobody buys stocks anymore, right?
Right.
Everything's indexed, everything is passive. And if you're going to own gold, you're probably going to own GLD or GDX. No one picks stocks anymore. And but I believe that that's another contrarian streak would be that I think stock picking is probably not a better time in history to be a stock picker, because the market has never been more expensive than it is today in history. And it's more expensive today than 1929. It's more expensive today than 1999. It's more expensive today than 2007.
And more concentrated.
Well, yeah, but this whole move to passive investing in ETFs and index funds. Why pay someone like me a fee when you can buy the S&P 500 for 4 basis points from Vanguard? And so and make 15% a year. And so that's the thinking, and that's everybody's drinking the Kool-Aid, and everybody thinks that until lo and behold, the penguins all go over the cliff together.
Right.
And so, but metals and mining, we went from gold, but then Brian's first idea he brought to our team was, now this is 8 years ago.
Okay.
8 years ago, and he had the idea to invest in nuclear energy and uranium miners. Nobody was investing in uranium miners 8 years ago. The only mention of nuclear energy 8 years ago was Chernobyl, Fukushima, nothing good.
Yep.
And isn't that amazing? 8 years later, how everybody loves nuclear today.
Joe, do you know Rick Rule?
I don't, not personally, but I know who he is.
Yeah. Good friend, known him for decades. He's in the same boat with you guys. He was on the uranium long before anybody else. When everybody else was afraid of Chernobyl and Fukushima, he was talking about it too. We've had him on the show.
Yeah, I mean, I don't know, very few people liked it 8 years ago.
Well, it was the two of you. It was.
There you go. There you go. Okay, but we were buying Cameco at $7 a share, and it's $70 a share today. So anyway, but then we that was then 8 years ago. We've taken a lot of profits, but we've really parlayed it into other. Now, first of all, I say metals and mining, so we only invest in companies, right? And no ETFs, and no commodities.
Okay.
Just companies, but companies producing these commodities. But really, like we love copper today. We love tin, silver, uranium, but really metals that are tied to the electrification of the globe. And everybody wants to own NVIDIA. Everybody loves the fact that Microsoft's building these data centers, but really nobody's stopping to ask, where are you going to get the copper to do all this? And Microsoft recently built a new data center near Chicago. It wasn't that big of a one either. And they put 4 million pounds of copper into this one data center. And I just blew my mind when I read that. And I just go, gee whiz. And then Richard Atkerson, who ran Freeport McMoran, he retired, but he said it basically, if they find a copper deposit today, anywhere between 15 and 20 years to begin production.
Right.
It takes a long time to build a copper mine. And so in our opinion, I think the move is irreversible, the electrification. but I don't think that supply is going to be able to keep up with demand, which will equal higher prices. And the same thing goes for uranium. Same thing goes for silver. Silver historically, precious metal, gold's stepbrother. But today, all half of all silver is used in industrially, and it's highly conductive, and used in solar panels and in all types of electrification, and of course tin. And tin, few people know what tin is used for. Tin roof, tin can. No, it's used for solder and electronics, and every piece of electronics, every piece of electronics in the world, tin is used for solder. And anyway, so that's where we're finding extreme value today.
Yeah, I love the uranium story. I love copper to death. I don't know if you know Robert Friedland, probably.
Oh,
Um, yeah,
uh,
he's got this thing. He said a couple years ago. I don't know if he originated it or if he got it from somebody else. Where he says basically we need 8 Escondida mines in the next 10 or 15 years or something. And they don't. Escondida, the biggest copper mine in the world in Chile, and they don't exist. They presently those 8 deposits don't currently exist. He's got one of them, and then where are the
well,
other 7?
but here's the other thing about mining is a lot of these mines are in areas that you hate that so Friedland's
Yeah,
his biggest mine is in the Congo.
yeah, that's
And
right.
and so I mean he's brilliant, amazing, but the a challenging thing. So when you pick a company to invest in, I mean, you really need to know where the assets are.
Yep.
You need to know how safe they are. Barrick had a big gold mine in Mali that was, I think, 10% of their production, and the government just took it.
Yep.
Just took it.
Yep.
And so you really need to know. There's that massive copper deposit east of Phoenix that Rio Tinto and BHP are trying to co-develop,
Hmm.
but it's an Indian burial ground. So
Okay. Yeah.
um, so there's just mining is really a difficult, um, but but what I love about it is they're producing products that the world doesn't turn without these products.
Yeah.
And so, but what I like about it, it's just not a crowded field. And so our edge is in picking the best companies run by the best people with the best assets.
Yeah.
And so that's why, if you like gold and you want to own GDX, which is all the big gold miners, you're going to get Barrick, you're going to get Newmont,
Hmm.
neither of which I want to own. you know um,
Right.
and so that's where it comes down to stock selection, and going back to my earlier comments to people that run these companies, how much stock do they own in the company? John McCluskey, who founded Alamos, is the biggest shareholder of the company. The guys at Newmont own very little stock in the company, and so anyway, that's just our methodology.
Yeah, and in mining in particular, which I've covered a bit over the years, um, there are several ways into it: producers, royalties, exploration and development, and then like what I would call like pure exploration and prospect generation, that kind of a thing. And in the case of Sprott Inc., which is one of my big picks of the last several years, um, finance. So it's an interesting space,
No, it
and
is.
some
I
of
mean,
this.
the royalty stream, Pierre Lassonde, right? Franco Nevada. I mean,
Hmm. Yeah,
it doesn't get any better than that.
yeah, the people.
But yeah, no, exactly. But our preference is really are the mining companies run by great owner operators.
Hmm. Okay. Oh, so do you own any royalty
No,
companies?
we do
Not at
not.
all. So you're focused on the producers. That's interesting.
Correct.
Um, who I'm curious to know who is a great owner operator. Let's talk.
John McCluskey at Alamos.
Alamos, good
Yeah,
one.
yeah, yeah.
What do you like
No,
about him?
symbol is AGI.
Hmm.
He founded the company. He's a huge shareholder. He's run the company for 22 years. The company has no debt, sitting on a lot of cash, and they have great assets. Mines are mostly all in North America, um, Canada, Mexico, and it's his company, and he runs it, um, you know, um, very shareholder friendly.
Great. And
Agnico's another one,
yeah,
Agnico, which has really done so well. But Sean Boyd ran the company for years and just did a wonderful job. Once again, safe assets in safe locations. Oh, and the other thing is great, great. I mean, like Alamos, their mines are very high grade, and the higher the grade, the lower the cost, right? And so all these things go into the mix, and so yeah.
cool. Well, we're on the same page there. I mean, if any industry, I bet you'd agree with this. If any industry will teach you how important the people are, it is mining and metals, like more than any other, because some of the people in that industry are outright criminals. And then when you find these high quality people, you wonder how they got there almost because they're kind of few and far between.
Did you
Um,
ever hear Mark Twain's definition of a gold miner?
oh yeah, yeah. Tell our listeners. I know it well.
A liar standing next to a hole in the ground.
Yeah, that's right. That's a joke, but the fact that it is so accurate so much of the time is really you almost have to see it to believe it. But wow,
Right,
I
right.
mean, some of these guys, the things they are doing, it's just
Yeah, and Mark Bristow at Barrick is I think maybe one of the
mm,
greatest mining executives in the world.
yep,
The problem with them is that they just, like I said, they had their mine in Mali confiscated. They're they're in,
yeah,
they're in some they're in some pretty tough neighborhoods. Their big new mine that they're bringing on is in Pakistan.
yeah,
So I just, man, do you want Pakistan or do you want Ontario? I mean,
right.
so anyway, it's all in the baking, right?
It is, and that's another thing. We're pointing out another thing. Let's just kind of name it to get scale. And there's no such thing as a really great small mine. To get scale, you need to be in all these weird. You need to be all over the world if you're not in, say, Canada or Mexico.
Yeah, well,
Or
I don't know about that. If you look at Agnico, I mean,
sure,
you know,
but not.
I
Yeah.
they're in Canada, they're
Hmm.
in Australia, they're in Finland
Hmm.
and Mexico.
Right.
So that's a pretty good stable right there.
Yeah. I didn't mean to suggest you need to be in bad countries. You do need to. You need to be in several countries,
Yeah,
probably.
yeah, yeah, yeah. No,
You know what
and
I'm
they
saying?
all are. They all
Yeah,
they all are. Yeah,
right.
right, right.
So
The
when
big
you're
ones all
several,
are.
yeah, you got to be careful. The one
Right.
mining jurisdiction that I learned of from the folks at Aya Gold and Silver is, that I never knew about until the last few years, was Morocco is
Mhm.
apparently a pretty good mining jurisdiction. I
I'll be
mean,
darned. I didn't know that. Yeah.
yeah, Aya Gold and Silver is there, and government's really friendly to them, and they don't have a lot of competition there right now, so it's kind of cool too.
Okay.
Um, the stock has moved quite a bit, but of course, the CEO Benoit, he insists that it's still cheap, right? So,
Sure. But I mean, so I didn't want it to be all about metals and mining. And
okay,
and by
sure.
the way, and if you did want to talk all about metals and mining, you need to have back my partner Brian Lax,
I was
who
thinking that. Yeah.
yeah, no, and Brian, really, I'm more of a, I'm much, I mean, well, we're both generalists, but he's really engineered our move in that area.
All right.
We weren't always 50% metals and mining. In fact, I think 6, 7 years ago, we were probably maybe less than 20% commodities, and that was mostly gold. So he's really engineered our move into. But we honestly we just own a collection, the non-metals and mining, the other half of the portfolio, just a collection of just like Bungie, just fantastic companies that were that we're very high on.
Okay, well let's lean away from metals and mining because we would like to have him on. As soon as you mentioned him, I thought, well, we need to get him on here. He's half your portfolio.
Yeah.
Uh, you know. So let's do that. But let's for the rest of this thing, let's lean into your strengths. Bungie sounds like a great idea. What is there another one that you feel like talking about?
Oh gosh, I love talking about all of them, and that's one thing.
Awesome.
That's one thing that kind of differentiates us from a lot of other people is that most people really, now in the day of index investing and ETFs, is stock picking is a bit of a lost art, But yeah, we have a new one in the portfolio, Builders First Source.
Oh, we just wrote that company up in my newsletter. That's cool.
Did you? Yeah, the symbol BLDR, Builders First Source. Once again, in monitoring insider activity, going through my Forum 4s every morning, and the chairman of the board is Paul Levy, and he made an open market purchase of stock. He wrote a check for $55 million. He bought at $111 a share, and you see that it's like the stock was down from 200 and 200 plus, but I like it. It's really an interesting company. It was originally it was the lumber supply arm of Pulte in the very beginning. And then it was spun off from Pulte. And so, in building supplies, like Home Depot really caters to the do-it-yourself customer.
Right.
And Builders First Source really caters to the professional builders and contractors. And they're the largest in the country at that. And the other thing kind of interesting about the company is that now, especially now, it's interesting, I built a house in California a couple of years ago, and it was the tradesmen were almost 100% Latino. 100, almost 100%, from demolition of the old house to finished carpentry of the new house. Almost 100% Latino workforce.
Yeah. I live in Oregon, so I know what you're.
And thank God for these people, right? I don't know who would do it. And my point is, with this immigration move that we have, it's really put a squeeze on the workforce. And Builders First Source, one thing they specialize in are prefabricated window systems, prefabricated door systems, and wall systems to take labor out of it, and which I think really plays into the hands of tight labor conditions and cost savings for the builder and the framing contractor. And so one little caveat, but very profitable company, a fortress balance sheet, and I think last time I looked at it, almost a 9% free cash flow yield. They have 600 distribution centers around in 43 states. And there's a lot to like about the company.
Would you mention Home Depots or something? These are like the one-stop shop for the professional. They're the Home Depot for the professional.
Well, Home Depot caters to the do-it-yourself, and Builders First Source caters to the contractor.
Yep.
Right.
And it's a lot of the revenue is for single family, which is kind of nice.
Mhm.
Given that that's where the big issue is right now. I think is there's just
Well,
not enough.
actually, I would say not really. I mean, imagine the multifamily. I mean, you're building apartment buildings. I mean, you have to go to these guys,
Right.
right?
True.
So so
True.
they
No.
actually, yeah, no, they actually have all of it. So
Yeah. Really cool business. And again, um, if you described it to me real quick, I'd say, well, that's isn't that a commodity industry? Well,
yeah, no, right, right.
you know.
But well, I think the other thing I like about it, the contrarian part of it,
Mhm.
is home building is not in a good spot right now.
Right.
I think
Yeah.
these stubbornly high mortgage rates have really throttled. And then the other thing would be that people aren't moving because if you have a 2.5% mortgage rate, you're not going to leave that house, and
Yeah.
so that's but the issue, the bullish side of it, is household formations continue to develop, and so I think you have a groundswell of demand that's building,
Right.
uh, and so I think it's very very healthy. People complain about interest rates. It's funny, the 10 year. What's the 10 year now? 4.3.
I
Uh,
know.
no. But I'm saying it seems high because it was 2.5% a few years ago.
Yeah.
But if you look at what is the average 10-year Treasury going back 100 years? I think it's 4.5%. I think it's right about here.
Yeah.
So rates are higher than they are, but
Sure.
they're not historically high. They're historically right in the mean.
Right. I think the bank rate 30-year, fixed national average something is in the sixes now, which I remember when I was younger. I remember people rejoicing, "Oh, mortgages are below 10% now." you
Right.
know? So it is all relative, isn't it? You need an appreciation for history to really get this and to get where we are with rates. But I agree that we cited household formation when we wrote this thing out, and um, the demand is there, and if you get any movement, we're starting to get movement on inventories. You get movement on inventories, you're going to get movement on price, and you're going to get movement on demand.
Mhm.
And you need building. The inventory isn't going to fulfill it. However you look at it, you need the building. New
You
homes need to be built. Period.
correct. Correct.
We didn't do it. We had a crisis. We're still recovering from 2006.
Yeah.
you know?
No, my hunch is that you're going to see a very robust construction business the next 5 years is my hunch.
Mhm. What do you base that on? Just what we've talked about, the household formation, rates
Household
being not
formation demand
terrible.
and pent
Yeah,
up demand.
yeah,
Yeah.
okay, right. We definitely agree. We're on the same page there. Well, we're value guys. All the value guys eventually wind up on
Right.
the same page, don't they?
Right.
Uh, all right. We are actually at the point where we like to ask our final question, Joe, and it's the same for every guest, no matter what the topic. And it's the same identical question. Sometimes we have non-financial guests and we ask them this same identical question. And it's for our listeners' benefit. If you could leave our listener with a single takeaway, a single thought today, what would you like that to be? And you can take your time if you need to think about it for a minute.
Yeah. No, I think it would be, I think the emphasis on the people that run these companies. And I think that when you analyze a company, I think you really need to zero in on the people that run the company, and you study them and where they've been, what are they doing, um, how much stock do they own in the company, how much do they pay themselves, and that's right there in the proxy for anybody to see.
Mm-hmm.
And I think you want to really invest alongside. You want to partner with a great owner operator. There's these activist investors that want to come in and change things, and we are just the opposite of that. We want to partner with a great management team and hold that company for the long run. I hate to quote Buffett, but everybody does. What's the ideal holding time for an investment, he goes, forever, right?
Yeah.
Probably the biggest mistakes I've made in my career are selling things too soon. And I give you a long list of companies that I bought it, I owned it, I made great money, I'm long term on it. I thought, well, I can, why did I sell Costco? Why did I sell Cintas?
Yeah.
Why did I sell Microsoft? I mean, just company after company after company where I had it right. I had it right, and I sold too soon. And so I love the idea of buying something and holding it for a very long time.
Amen to all that, Joe. And thanks very much, not just for a great final question, but thanks for being here. I appreciate it. I thought it was, I learned a lot from you, and I know our listeners did too.
Well, that was a really fast hour, I'll tell you.
I know it is. It's quick. We don't even necessarily go a whole hour. We just, wing it. But we certainly will be inviting you back, sir.
Great. I really
Yeah.
appreciate the opportunity. I had a lot of
Yeah.
fun.
And we need to get your partner on here too.
He'd love to do it.
Okay, great. All right.
Great.
Thanks, Joe.
Thank you. Yeah. Bye.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.